From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Hello, and welcome to another episode of the Macrocast. I'm your host, Ylan and Managing Director at Penta. Today, I'm joined, as always, by Brendan Walsh of Markets Policy Partners. John Fagan, who's usually on the pod with us, is out today, but we do have a special guest. That's Wendy Edelberg, Director of the Hamilton Project and a Senior Fellow in Economic Studies at the Brookings Institution. She's a perfect person to help us break down the jobs report and the Fed decision. Welcome, Wendy, and hello, Brendan.
Thanks for having me. I'm excited to be here.
Great. Well, let's dive right in and start with the numbers because the Labor Department has now reported that the economy once again beat expectations, adding 253,000 jobs in April. The unemployment rate now is at a 50-plus year low of 3.4%. So, Wendy, this job market just keeps churning along despite the Fed's rate hikes, despite talks of a recession. What's going on?
So that is indeed true. This job market has continued to be very strong. And I'm sure we'll get to the point that I think it's unsustainably strong. But what was also important in this release was important revisions, downward revisions to employment gains in February and March. And so we now see more of a consistent downward trend in employment gains since the middle of 2021. And so now the 3-month change, the average 3-month change in employment through April was 222,000. In comparison, the average 3-month change through January was 334,000. And that 3-month average has just been slowly coming down. It's been slow, but slow's good. And this suggests to me that maybe the labor market is getting to a healthier place without causing too much pain.
Your point of revisions is huge. So I used to work at a hedge fund, so I did a lot of analytical research on the jobs number. And it just kind of gets forgotten both in Wall Street, but also by the media. The revisions between what gets printed on today and what in 2 years, actually, the final number ends up being can be massively different, like 500,000 jobs different. So it's always kind of a leading indicator. When job revisions start becoming negative, it's a sign that the economy is really, really cooling.
Yeah, so I guess you guys are saying that some of the excitement over the beat of the headline number today might fade as we sort of see what the revisions are in future months. Brendan, I know you've also discussed the leading indicator of temporary jobs as another important factor to watch. When we look into the guts of this report, we see that the temporary job sector was down another 22,000 jobs, I think, this month, coming off of job losses last month. Why is that such an important figure to look at?
Well, it's just kind of like, it's very simple. Like if you're expanding, you don't have time to interview people. So you hire a temp to fill that, role for a temporary period of time. You might hire them permanently, but if you're laying off temps, that's an even worse sign. So not hiring temps is a leading indicator, but if you're actually laying off temps, it's a sign that your business is slowing. So that's the first line of cuts that's going to happen.
One thing I want to jump in and say is you talked about the excitement of the headline number being big. I'm actually excited by the slowing. So we need to see, we know that monetary policy is trying to slow the economy. We know that given population growth and given very long-term trends in labor force participation, a stable, period after period, replicable labor market has employment gains month after month, more on the order of 75,000, maybe 100,000, probably lower than 100,000. So we've got to get from where we are to that stable pace if we're going to get inflation under control. And this has, so I'm excited by the slowing that looks like it really might be able to happen without a painful increase in the unemployment rate, without a painful contraction where, employers overreact and cut back on employment in some drastic way. So I'm excited about increasing chances for a soft landing.
What about immigration? Because of COVID, we didn't have any immigrants and policy too. But now we're kind of back to normal, and we have an administration that it's kind of encouraging immigration. I know we saw a little bit of the 2022 numbers that we increased, but not back to what we used to be. How big of a role do you think that's going to play?
I think let me put it this way. We for sure, in my mind, have a smaller labor force than we would have in absence of the pandemic. And that's
for like a host of reasons.
Well, so two main ones. The most depressing one is mortality.
Yeah.
We lost people who would have been otherwise working. And the second big one is immigration. Now, it's really hard getting a handle on how much smaller the labor force is right now than it would have been, because population numbers have been revised in a really complicated way that makes comparing to like 2019 or trends between 2017 and 2019 makes that really complicated, because the revisions were put into recent data and not into that pre-pandemic data. So if you untangle all of that, what you see is that yes, for sure, I think we have compelling evidence that the pace of immigration is back. I'm sure in no small, part because of what the Biden administration has been trying to do with getting all of the systems up and running again, and going through backlogs. But my best estimate is that the level of immigration, the overall number of immigrants that we have in the country, is still below where you would have thought it would be in absence of the pandemic. But I don't want to overstate this. It's probably on the order of like a couple 100,000, which in the scheme of how big the labor market is.
Yeah, that's a good point.
It's not massive, but I don't think we're still quite back to the levels. I just got way in the weeds. To get to your basic point of what does this mean for the whole economy, I think what this means is that we are on track, even more importantly, because of mortality, because of the deaths from COVID, we are on track to get to what is sadly going to be a smaller economy than what it would have been. And that means, if I think we have labor demand that is basically like it was pre-pandemic, but we have a smaller labor supply than we had pre-pandemic, and those two things just can't go together. And I think that's one of the reasons we're seeing so much heat in the labor market and so much tension between supply and demand. Yeah.
So civilian labor force is now at 166 million, 66.5 million, which is below what we used to be in terms of percentage, what 63% or so. But it seems like we're stabilizing there. We're not going to keep increasing the civilian labor force.
Wendy, what do you think the impact on wages is because of this? I mean, we saw pretty solid wage growth in this report. I believe that year over year, wage and average hourly earnings up 4.4%, up 0.5% month over month. I mean, does the smaller labor force with pre-pandemic level demand equal higher wages for how long?
For sure. My best guess is there are two things that are going to be important to answer that question. One is how long demand stays high. And, we're on track for it to cool, but we'll see. So I don't know until we get to something like employment gains more on the order of like 75,000 a month, we're going to see upward pressure on wages. The other thing that's more depressing is if higher inflation expectations have made their way into those wage numbers, that could mean that it takes a lot longer to bring wage growth down. So if both firms and workers kind of expect inflation to be, 3.5% over the next year, and let's say we're talking 6 months from now and somebody's setting a wage for the following year, and then they say, we all kind of sit down and we agree that inflation is going to be 3.5. We're going to set your wage at that plus a little, because you've been really productive over the past year, that's the way that near-term inflation expectations can get baked into the wage data. And then that has a mind of its own. I don't see a lot of evidence of that yet, but that's the other thing that could influence how quickly wages come back down to earth.
Yeah. And also, so we report the overall number, but the BLS does break it down by, income. And really, so much of these gains has been in the lower end, which is a very good thing. They needed to very much catch up. And we're actually seeing kind of wage losses in the higher sector, especially the tech sector, where, every day there's a new announcement of layoffs. And also it's seeping into the financial sector. Morgan Stanley is laying off people, Goldman Sachs laying off people. So it's a little bit of a rebalancing, too, of, wage gains from the upper class to the lower class.
Let me ask this, because the other big piece of news that we got this week was the Fed's decision to hike rates at its most recent meeting, but it also gave some pretty strong indications that this is it, at least for the time being, that it doesn't plan to continue to hike in the future. Do you guys see anything in today's jobs report that would give the Fed pause about its plans to pause?
It's interesting. I mean, my short answer is no. I think that the news in today's report goes in the direction of the Fed standing pat, partly because of the news about revisions that we talked about, and that there's overall evidence of slowing. What goes in the opposite direction is the stuff that we saw on average hourly earnings. Now, the earnings data in the employment report is totally mucked up by composition. So it's just looking at like the average hourly, literally average hourly earnings.
Yeah. Of everybody. Yeah.
Across everybody. And so if you're pulling in a whole bunch of people who are higher earners relative to the number of lower earners that you pulled in, that can muck up that average. There are ways of trying to correct for that, to see what the real read of average, of like taking out composition. I haven't had time to do that yet. They will have had time to do that by the time they make that decision. They'll have some other indications on wages, but that goes in the other direction. I mean, the other thing is that I think goes in the direction of the pause is that we have a fair bit of evidence in hand so far that consumer spending is on track to be slowing, and may well even like outright, I'm sure I'm overstating it, might even contract in the second quarter. I think that's probably overstating it. It's going to be weak. We're going to see weak growth in the second quarter in consumer spending. That to me is, as far as the real economy goes, going to be really important for the Fed. Consumer spending has been wildly strong. And I think a big reason why we've seen the inflation that we've seen. And so that slowing will be another reason for them to say, you know what, let's stand pat and see how this works its way through the economy.
Yeah, I think it's a really important point. But it's also a point that I think we're forgetting. Like, we went through a pandemic. We're supposed to stay home, and now we're allowed to go out. So, we just had, first quarter earnings. And anybody that sells stuff is not doing well. If you sell experiences, you're doing well. Marriott's crushing it. The cruise lines are crushing it, and the airlines are really doing well. But you're not buying other things, and that should be expected. But it's going to normalize,
Brendan, I know that you guys have been expecting a Fed pause at this meeting, but they put it off for one more meeting. Do you think the Fed is going to be able to hold on to the level of rate increases that you think the Fed will be able to defend its current level? And I think that's
the more important question going forward. I don't think they're going to hike again. I think it would be a mistake. I honestly think it was a mistake to do the 25 year, especially everything that's going on in the banking sector. But more importantly, the market is pricing in cuts in the second half of the year, and the Fed is adamant that they're not going to do it. So I think the best way that the Fed can hold rates where they are is by stopping and not over tightening.
It's funny, in my mind, the compelling reason for the Fed to cut. So let me start this by saying, I think that the Fed will stand pat basically through the year, but
totally agree. Yeah.
The reason that they would cut, I think, would have to be that they have very clear evidence that if they don't cut, they will undershoot on inflation.
Yeah.
Which is to say, if they don't cut interest rates, broadly speaking, what people's models, what the Fed models, what private sector models are pointing to is inflation coming in under 2%, under the target in like the near term. Like not 2 years out, but let's say in 2024, we're going to get inflation of under 2. If they had a lot of evidence that looked like it was on track, then I can see them saying, you know what, we have to cut because that means if we don't cut, we will have overdone it. I don't see a world where any credible model says inflation's gonna go under 2 unless the Fed cuts.
Yeah, I mean, we're here in May, so you're talking about, I don't know, November. So we get back from summer, and the economy is just a completely different economy than it is today. It just doesn't really work that way.
Yeah.
And wouldn't the Fed have to accept some period of below trend or below target inflation in order to, quote unquote, make up for all the years of above target inflation that we've had, or all the months of above target inflation?
Well, no, that's a really important point, because we did QE and all this stuff to get in. So we have a 2% core PCE inflation target, which they never hit. For 25 years, it's always been below. So they were doing everything to try to get it up. Now we actually we're above it, and we're doing everything we can to get it below it. This is an amazing opportunity for them to reset. And maybe why do we choose 2%? Maybe it's 2.5 should be the better one. But instead, we're doing everything to shrink the economy to get down below 2%.
Wendy, you should ask your colleague Ben Bernanke about how many years it took him for folks to agree on a 2% inflation target.
Yeah, and I think it was set by New Zealand, wasn't it? That's where 2% came from.
So it certainly was not set with like a massive amount of like empirical research saying not 2.5. But my guess, I mean, I don't think you're gonna hear anyone at the Fed say anything about raising the target until inflation is just very obviously under control. And
it's a credibility issue. And I don't blame them for that. Yeah.
That said, you know, my guess, this is more sociology than economics. My guess is that once we get to a point where inflation is, you know, like core PCE inflation is around 3, just a bit above 3, maybe a little below 3, and the projections that the Fed is writing down are just consistently like, no, next year we're totally going to get to 2. Like, yeah, we know we've been running at 2 3/4. Next year we're totally going to get to 2. And much the same way, they were doing that from below. Like, yeah, we're at 1 3/4, but next year we're totally getting to 2. So I think they'll, for a while, be at like 2 3/4, 2.5, and they'll just keep saying, no, it's next year. No, it's next year. And the market will like totally forgive them for that. And then at some point they'll say, hey, you know, it's what we really meant is it's a band. We really meant that's what we really meant this whole time.
What we really need is another umbrella or fan chart, right? Or really fan chart.
But I think your point, you made a really enlightening sentence there. It's more sociology and economics. And we think that economics is like physics because we use Excel and we do regression analysis. Economics is much more sociology than it is quantitative. And I think we lose that. It really is just everybody in the world is making a decision, and that ends up in a GDP, number. And especially like we just had this bank run, and the bank run had nothing to do with fundamentals. It had everything to do with, social media and people, freaking out. So I think that the Fed needs to spend as much time on sociology as they do on their regression models.
Well, to your point, Brendan, let me ask this question of both of you, really. I'm jumping ahead a little bit, but let's just power through. If the bottom falls out of the economy, let's say there's either brinksmanship, a short-term default, or even a protracted default, and inflation expectations or inflation projections are still, not quite below 2% just yet, but Congress is stuck and there's no fiscal stimulus or counter-cyclical policy coming out of Capitol Hill. in that environment, wouldn't the Fed cut rates because they're the only support that the economy can receive? The only adults in the room. Absolutely. I mean, maybe there's not an economic reason to do it, but there certainly would be a strong political and sociological reason to be the backstop to the economy at that point.
So I think so let me take that into a few different parts. If when you're talking about brinksmanship and you're talking about the debt ceiling, so if indeed we get to the point where the debt ceiling binds and Treasury has to juggle payments, and we have what I assume and hope would be only a very short-term episode where we're dealing with all of this and we need policymakers to get their act together. What I think will spur them on to get their act together is that markets, the stock market will tank, the bond market will go into massive gyrations. The financial system will, threaten to break in various ways, and we'll have 3-inch headlines above the fold. And in the midst of that 36-hour period, we won't have a ton of economic information to say what the effects of that are, but the Fed will see all sorts of massive and frightening disruptions in financial markets. And I think that my guess is that regardless of what inflation is at that moment, they will stand up facilities, open windows, do whatever they need to do to stabilize the financial system. But now, if indeed, just walking down the whole debt ceiling, walking through the debt ceiling scenarios, my guess is that all of that disciplines lawmakers, and there is the debt ceiling. And for the next 6 months, we'll be talking about where we see it persistently in the data, or don't we see it persistently in the data, and blah, 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 and did it raise borrowing costs and that whole thing. If at the end of that 36-hour period, which will be really bad, they don't raise the debt ceiling, then all bets are off.
Yeah.
Then, oh my God, what's happening? It probably triggers a recession. Yes, the Fed does stuff, but we have cascading problems.
Yeah. And the problem with that scenario is that we almost have to actually default for markets to massively sell off. Because if you're Fidelity and you run a $200 billion equity fund, you can't sell anything. There's nothing you can do. So you just assume it's not going to happen. And so it's always this disconnect, because we have hedge fund and buy-side clients. We also have a lot of contacts and clients on the Hill. And the Hill always says it would be really nice if we had, markets sell off. And when you talk to market participants, what am I supposed to do? I can't assume that we're going to actually default on our debt.
But also, what do they buy? So they sell off.
Yeah.
And then, what do they hold it in cash? Well, cash is still dollars.
You don't really want that either. Yeah.
So I mean, I've never really understood how to monetize the information in my head, but I don't know what you buy. And then, frankly,
what you do is you buy that sell-off.
Right. Far be it from me to give financial advice, because, oh my God, what happens when the debt ceiling binds? All of it happens. And then, oh my God, what happens when there's a flight to quality and it lowers interest rates?
Well, that's the ultimate irony. When we got downgraded, treasuries rallied.
Yes.
Because there's crisis going on. What do? We buy treasuries. What's the safest? It's treasury.
So when you think about the I guess the political dynamics of a market gyration or market volatility, what I am sensing now is that Democrats are more worried about the risk of default than Republicans are, right? Republicans seem to feel that there's the ability to prioritize the debt, that maybe a default won't be so bad because, hey, Treasuries are going to rally anyway, right? That the financial repercussions will not be as severe. There's this massive distrust of what the Biden administration or senior economists are saying. And so I think what worries me is that creates this sort of uneven playing field in which, one side is, going to be pressured into making a deal perhaps more quickly than the other because the fears are not balanced.
I don't think there's any deal that we're getting out of my, I'm not a political expert by any stretch, but I'm not sure that there's any deal that the Democrats could stomach that would satisfy enough Republicans for the McCarthy to keep a speakership.
I think it's a really important point. Yeah. So I saw it really. So the CBO scored. So they scored Biden's budget, which is, when the president releases their budget, it's never going to pass. You just throw everything you could possibly want into it, and they just scored the budget that the Republicans passed. What we're talking about is literally $160 billion a year, and that's from something that's never going to happen to also something that's never happened. So once Trump took off, Social Security and Medicare, we just don't spend money on anything else. So the Democrats aren't going to, you're basically cutting off all other social spending, and they're not going to agree to cut that. And I agree with you that there's 15 Republicans that actually think defaulting is a good idea. So I think this is going to be very difficult. And if you do a bipartisan bill, I'm with you. I think McCarthy loses his speakership.
Yeah. What is bipartisan in this era, right?
Some people mistakenly think of this as sequestration. So
yeah.
The idea of sequestration is that if Congress doesn't do something responsible budget-wise, they set up rules for themselves where just automatically there's spending cuts on various things, and you can have sequestration. We've had sequestration in various laws that affect discretionary spending broadly, that have affected mandatory spending in various ways. And sequestration is a terrible thing because it's just everything gets locked by some amount, and it's just not surely. But that was never anybody's best optimal policy choice. But we have lived through periods of sequestration where we just lop off spending. And I think in some ways, budget hawks have, thought that that's not all bad. And I think people are mistakenly thinking of letting the debt ceiling bind as basically sequestration.
Yeah.
Fine, let's just cut spending by 20% and live within our means. And it's no, that's not how this works.
Yeah, I had somebody ask me the other day, will the national parks be closed in the summer? I was like, that's when we shut down the government. That's a whole different thing. This one's really a nuclear event.
This is not a government shutdown. This is not everything working, but just not quite as good as it did before.
Yeah.
Oh my God.
Essential workers, or this is not being able to suss out what is an essential worker and what is not. This is about full faith and credit.
This is the Treasury pay your Social Security check.
Right. Well, we will find out more once President Biden meets with congressional leadership on Monday. But for now, this conversation has been so wonderful, so engaging. We could keep going, but unfortunately, we are out of time. I want to thank Brendan, as always, from Markets Policy Partners for joining us. You also, of course, heard from Wendy Edelberg of the Brookings Institution. Thank you both for being here. Thank you to everyone for listening. And please remember to like and subscribe wherever you get your podcasts. Have a great day.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.